Hello again, and welcome back to Win-Win Investor. This is episode 2, recorded April of 2019, of the Win-Win Investor Network. As we mentioned in our last episode, we're going to delve in the next few minutes into a very nuanced and somewhat lesser known aspect of the real estate business and real estate investing. We are looking at the world of mortgages. And specifically, we're going to look at where the paths of Main Street and Wall Street cross in a market known as the secondary mortgage market. To take you back a little bit for those that may not be as schooled in the world of real estate and mortgages in the United States of America, we as a country have about the 20th highest percentile of homeowners that own their home. About 65% of American households own their own home as opposed to being tenants. Now, most of the countries that top us on that list, they go as high as places like Singapore, where home ownership is great, by some accounts greater than 90%. But when you talk actual numbers of people, America is a pretty big country. And so that means that well over 150 million Americans own their own home. And one of the ways that this has been possible, one of the aspects of American financial system that makes home ownership possible and makes mortgages available to millions of Americans at relatively reasonable rates, is a 30-year fixed mortgage that can be sold as a commodity, as a whole loan, on the secondary mortgage market. So whereas 100 years ago, banks could only lend the money out that they had in their particular company, now banks can bundle and create tons of mortgages in local municipalities and then bundle those together and sell them off to bigger banks, institutions, governments, sovereign wealth funds, and then they can reuse that money. And that's how bankers and loan officers and lenders keep the system fluid. Well, for those of you that were around about 10 years ago, that system got itself into a little bit of trouble. It was known as the mortgage meltdown of 2008. And a number of factors played into that I won't get into here today. But you can read about it in my book, Win-Win Revolution. And you can also go look up books like The Big Short, which was actually a major motion picture. And there are a lot of movies and books that have been written about what transpired in 2008. But basically, the real estate market crashed. And it was as a result of a number of factors, but it was mainly due to light leniency in lending, combined with a lack of police patrolling on the type of loans that were given to what people, and then this faulty belief that markets aren't cyclical. And as we now have come to learn over a decade later, markets very much are cyclical. So when I got involved in this business, it's what we're going to refer to here as the NPL market. That is a term that is referred to as the non-performing loan. When a certain percentage of loans go into default on a regular economy basis, maybe 2 to 4% in any given market, there is a loan that is pledged against an asset of real estate, and that when that loan goes into default, you have a non-performing loan. Well, this is a market that's been around for decades now, but it really came into prevalence in 2008, 2009, when the default rates in America went from the average of 2 to 4% that banks were always anticipating and planning for and had systems in place to handle. It went to, over a period of less than a year, it went to tenfold in some areas. Default rates were 20 and 30-fold in very poor areas. But on average, you had about a 7 times the number of people in default than you normally would, as default rates went into 14%, 15%. You can imagine the influx of distress in the residential and also in the commercial real estate markets. But where we really felt it was in the residential markets. Well, at the time, I had been a real estate fix and flip investor in the early 2000s. And I had personal experience with the freedom of lending that existed then. I had friends who had 4 or 5 properties but didn't have a job. And I think we all know that some friend or family member or acquaintance that got wrapped up in a downward real estate market and a distressed mortgage market. On some upcoming episodes, you're going to hopefully have the chance, we're going to have the chance to interview some people that have been in this industry and been through the ups and downs in the financial markets and in the real estate markets and the market economies. I find bringing some perspective into the conversation really helps solidify one's understanding of this market. And I also think it helps us better prepare for the next event that may be coming, whatever that may be. So in some upcoming episodes, we're going to have a chance to meet some people that have had a very influential time in part of the mortgage crisis. These are people that in some cases were very successful as a result of the availability of NPLs, non-performing loans. My interest level is really in first lien mortgages, and I'm going to tell you why very quickly. What we're interested in is the underlying asset, right? Being a generally risk-averse person and wanting to always hedge one's investments, I have always loved real estate investing because even when the market goes down in real estate, except for the one time in 2008 when there was obviously a very unusual series of events that took place, traditionally, land ownership and real estate investing is considered to be one of the safest investments in America, and where much of the long-term wealth in this country has been built has been through acquiring and holding on to real estate or taking advantage of cycles in real estate. In 2008, the summer of 2008, the markets were teetering. It was a few months before the failure of Lehman Brothers, which for those who were around and were paying attention 11 years ago, was really the pinnacle moment when a major investment bank actually overnight closed its doors and went out of business. And there are books written about Timothy Geithner and the Treasury Secretary's experiences during the summer and fall months of 2008. It was just during that moment, that summer, that I got a call from an asset manager in Southern California. As I mentioned, I had some fix and flip residential real estate background. Had done very well buying and selling houses in the residential field. I had also been involved in commercial real estate development on the retail and restaurant side, representing retailers and restaurants. So I had a little bit of an understanding of all aspects of the market. We saw that the residential market was on the verge of a collapse, and I got a call from an asset manager in California who said, "I'll tell you what, I'm looking at 2,000 construction homes loans on new construction homes in Port St. Lucie, Florida." That's a town about 45 minutes from me north of Palm Beach, where I live. And I was very familiar with all the new construction speculative housing that had gone on there in the middle 2000s. And he said, basically, I get to name my price, and I'm looking for someone to advise me on the real estate. We see a lot of solidly built, brand new homes sitting here, and the bank is now turned these into non-performing loans, NPLs, and they're sitting on the bank's balance books, and the banks have to sell them, and they're going to take a loss on them, and I get to name my price. For me, this was a light bulb moment. This was an opportunity to get involved in the secondary mortgage market. Here was a guy who had access to buy these mortgages with a face debt amount of X. Say your average one was $300,000, and new construction homes. So the asset was there, the land and the house were there, and they were pledged as first lien collateral against these notes and mortgages. Well, to me, that was a very adjusted reward opportunity, as long as we were paying the right price for the assets. I jumped on board with this fund manager and subsequently got my feet wet in what is known as an old boys club. Now, granted, you're asking, well, if you buy mortgages, how do you buy them? You can't exactly get a mortgage on a mortgage, and that's true. This is an industry that requires cash. And I will tell you, at the time that I started in it, just over a decade ago, I didn't have much cash. So I had to start small. I started as an advisor. I got my foot in the door. I started trading with fund managers, starting introducing investors to the concept of buying non-performing loans and working them out. There are multiple of strategies that are available to you when you own the first lien note on a property, on any piece of real estate. In essence, I saw us as really being in control. And so from there, we created a paradigm because we knew that I hooked up with some other fund managers and subsequently got hired to manage a $100 million Florida-based portion of a $250 million NPL portfolio. And when I took on this role of getting involved in acquiring these mortgages and working them out, we decided that we wanted to take the approach of creating a new paradigm. We didn't talk about debt because at the time people were struggling. And people today still are struggling, people that are in default. If they miss 5 or 6 mortgage payments, the last thing they're interested in doing is picking up the phone and telling you how they're going to make 6 or 7 mortgage payments. So we have gone out and purchased these non-performing loans through connections at the banks, through connections at other funds, and we've bought them at a discount to their face value, at a further discount to the underlying collateral value, the real estate that we are a first lien on, and yes, you could say we're in the business of foreclosing on homes. But I'll tell you, our paradigm was not about foreclosing homes. We built a model that was based on the idea that we want to try to keep people in homes. So the first thing we always did was look to modify and keep people in their homes. But there's a whole slew of options, loss mitigation options, and ways of treating borrowers that are more humane, that also was able to allow us to resolve mortgages in a much quicker manner than waiting to foreclose on someone's house. All of this is illustrated in my book, Win-Win Revolution, which I'm going to make a little bit of a pitch for here today. You can pick this up on Amazon. It is available on Kindle Unlimited. It's Win-Win Revolution. And it talks about the paradigm we created, and it discusses the details of what we do when we go out and consider purchasing this debt at a discount and resolving these distressed debt situations. I think that's going to be it for now. We're going to come back on our next episode and introduce you to some key players in the industry. We're going to talk a little bit more in detail about the specifics of how we acquire non-performing loans. We're going to talk about things like UPB. That's the unpaid principal balance. Unpaid principal balance on the loan. UPB is going to be one of the topics of our next in our next conversations, and we're also going to talk about BPO. BPO is broker price opinions. Broker price opinions are one of the keys to getting this business right. Broker price opinions are where you turn to real estate brokers and to local experts to get valuations. One of the terms you're going to hear me say quite a bit is there is no such thing as a bad note or a bad mortgage, just a bad valuation thereof. And so our entire business is built upon purchasing mortgages, first lien mortgages and notes at a discount to the broker price opinion value. And in the event that the UPB is less than the broker price opinion value, meaning there's equity in the house, then we look to purchase these notes at a discount to the UPB, the unpaid principal balance. All of this plays a role in our ability to go out and one of two things: either make money in a unique way without much risk because the underlying investments are backed by real estate, or it could be a real estate investor's avenue to acquiring new real estate at a discount. And many of the people that I will introduce you to have done both. You'll meet those of us that work every day to make a return on investment for investors in the NPL space. And I'm also going to bring in and interview some investors who have acquired notes as a safe place to put their money, and in turn have ultimately, in some cases, ended up owning the real estate, which via an avenue that offered it at a greater discount. So, in summary, this is a little bit more of a sophisticated real estate investment than most are used to. And I do promise that here on the Win-Win Investor Network, we will address more simpler real estate investments. We'll address single net, triple net, 1031 exchange properties and commercial. We will be covering simple real estate rental formulas, the rich dad, poor dad technique, you could say. We'll talk about wholesaling, residential real estate, and we'll talk about just simply purchasing fix and flip residential real estate. That is something that many people are pretty familiar with. There's a lot of television shows about it, fix or flip. But we'll get into some of the nitty gritty, and that'll be just one of the many topics that we continue to discuss here on Win-Win Investor. I hope you've enjoyed today's episode. We'll see you in a week or two. And please, if you like us, subscribe. Please click subscribe. My name is Bill by Mel. I hope you get a chance to read my book, Win-Win Revolution, available on barnesandnoble.com, on amazon.com, and also on the Amazon Kindle Unlimited program. Thanks again for joining me. My name is Bill by Mel, and this is the Win-Win Investor.